The due on sale clause is if you transfer the property, if I'm your lender and you're signing a contract, the mortgage that says if I default, you can foreclose on me. That's what a mortgage is. Okay. So one of the clauses that I as a lender put in there is the due on sale clause. If you transfer the title to somebody else without my consent, I didn't get into a relationship with Jim Bob. I got into a relationship with you. So if you transfer it without my consent, then I can accelerate the loan. I can call the whole loan due. The full balance is due in 30 days. That's your next monthly payment, and it's a fat one. And if you miss that payment, I can foreclose because of your non-payment issue.
Hello, everyone. Rick Albert here with another episode of the Key to City of Angels. I'm super excited because we're going to be talking about creative financing, which always comes up with my investors and up-and-coming investors. So I have an expert on the case, Caleb Christopher. Thank you so much. Yeah, you, of all people.
Yeah, me.
Yeah.
Glad to be here. Thanks for having me on, man.
Yeah, of course. You're the founder of Creative TC, DOS Guard, Creative Title. Why don't we first talk about how you got into this space and then a little bit about what each of those companies do, and then we can dive into the questions.
Yeah, I came from, I'll just say risk management, and that's a whole ball of tape that includes physical security because I worked at a prison, bachelor's degree in cybersecurity and working as an IT consultant. And so all of those things, I like the risk management side and saying, what could break this and how can we prevent that? And so then I read Rich Dad, Poor Dad at one point. So long story short, now I'm in real estate, right? Easy. Mm-hmm. Everybody's got the same story, right? But I'm bringing the risk management factor in. And I'm also a nerd. I read laws and case law just for entertainment. I have a book on land trusts in Florida. This was recreational reading for 2 nights for me. It's what I do for fun. So I bring that stuff to the table and I'm like, how could somebody break a transaction? Because I got involved in real estate, like wholesale deals, and I bought a flip and I have a couple of rentals. And I'm like, I just see a lot of gaps where people can accidentally either screw themselves or somebody else. And I'm like, So that's my background and what I'm coming into. And that's where I saw the opportunity to create the consulting firm, Creative TC. That's transaction consulting.
Okay, very nice. Yeah, it's always interesting because like when I've talked to people about the issues they have in their transactions or issues with tenants, whatever, I'm like, most of the time it was preventable.
Yeah, I just told my pastor this because I also have a background in project management and a certification there. Mm-hmm. I had an alphabet soup of certifications in IT and cybersecurity, by the way, like 13 plus certifications at the same time. Yeah. I test well, right? If I read books like that for fun, I can take tests pretty well. Right. So I told my pastor, I said, hey, we chose not to use a general contractor on our church expansion. We're going to run into problems that nobody could have predicted. And it's literally nobody's fault. Right. The difference is we chose to save money by not paying somebody who would know what we can't know. And so when we have problems, don't say, oops, this is expected, you guys. Hey, we ran into another problem. We're going to get through it and we'll just get to the next one. And the project will be done at some point. But don't cast false hope that was the last problem we'll run into, because it isn't.
No, that's fair. Yeah, you don't bring in the experts or whatever the case may be, and there's always going to be some level of learning curve.
Yeah, it costs you one way or another. Time, experience, money, losses.
Okay. So then translate this now to what you're doing today with all the creative financing. In creative financing, we're talking subject to deals, which is you're assuming someone's mortgage. You'll explain it far better than me, or seller financing. Okay, so just so you know, and I tell this to all my guests, I'm a smartass, not a know-it-all. So if I don't know something, I'll ask, and that's where you come in. So go for it.
I love it. I'll put it this way, subject to. Let me explain that specifically. Every house you've ever bought is a subject to deal, just not the way that people refer to it. For example, if you bought your house and the utility comes and starts digging up the front of your yard to do something, can you actually legally go do anything about it?
No. If they're going to dig, they're going to dig because they have to.
Because of what? What do they have?
Oh, the easement.
They have a utility easement or a right-of-way or something like that. Mm-hmm. You bought the house subject to that company's right to dig up your yard for when they need to do something about it.
Okay.
You bought it subject to that. So when you think of it that way, if I buy your house subject to the mortgage, I buy it subject to the terms and conditions that are still attached to the property, being your mortgage. Mm-hmm. The loan exists. It must be paid. This is the interest rate. If we default, this is what they can do about it. All of that is included in the subject to.
Mhm.
That super simplifies the concept or brings it back down to earth. Like every deal is a sub 2 deal. We're just adding the mortgage to the list of sub 2s for this particular transaction.
Got it.
That's the function of it. The reality of it, the practical conversation version is I'm going to take over payments on your mortgage. Now, you said assumption, and you said I am correcting. It is an informal assumption. I'm agreeing. We're agreeing privately for
Right.
me to make your payments, but they're still your payments. Like when you say assumption without saying anything else, we're going to assume it means formal assumption.
Got
Meaning
it.
we ask permission from the bank. Hey, can I take over his loan? Can you replace his name on the bottom line with mine and me be the borrower now? That's an assumption. An informal assumption is let's ask forgiveness, not permission. I'll just make your payments.
Got it. Now, who ends up on title though?
Oh, me as the buyer?
Yeah.
Yeah.
So you're on title, but the loan's still in the previous owner's name,
Yeah.
basically, and then
Yeah.
you're just making payments.
Yep.
Okay. So let's do both sides of this. So why would a buyer want to do this, and why would a seller want to agree to this?
Buyer side's easy. My credit's not attached to the transaction, which that's attractive because if you can only get so many traditional loans, like if you're a serial buyer and you've got your 10 loans or whatever the number is for Fannie Freddie loans, you can't get any more new conventional loans. So you're capped out. So it doesn't count toward that limit when it's not on my credit. It also, good or bad, I'm not the one who gets a hit on my credit report if a payment doesn't get made. Additionally, again, this is all buyer side. Usually we can get into one of these deals for less money than it would cost me to get an investment property loan. If I have to bring 30% down to get into an investment property loan, 30% on $1 million property is $300,000. What if you're low equity and I can just take over with $50,000 cash to you and I just step into payments, your payments? That's pretty attractive too. So for the same cash in my bank, I can probably do more deals, acquire more deals.
Got it.
Additionally, you probably have a lower interest rate than I can get on an investor loan as well. So you may be sitting on a 4% rate, which is pretty rich right now, or even a 6, but mine would have been a 7 or a 7.5 or something like that as an investor loan. So there's lots of investor incentives to do this, or buyer side.
Sure.
The seller side, it's usually about pressure or price. I've got a problem that I need solved. I'm going to get foreclosed on. I can't afford the house anymore. It's not selling on the market. I have low or no equity. It's going to cost me money out of my pocket to sell with an agent. The agent commissions on a big house are pretty expensive. And if you're low equity, think of the veterans loans, the VA loans, 100% financing. You have literally zero or possibly negative equity. So if you sell, you have to write a check to even sell your house. That doesn't feel right.
Okay.
Is it right? Technically, yeah, but it doesn't feel right. And so if I come up to a veteran who just got new orders to move somewhere else, and it's going to cost them $50,000 to sell their house, how about I just take over your payments? Maybe I'll even give you $5,000 or $10,000, right? I'm buying your rate. You're not. Right. It's not that you're not making $10,000. The economic impact is $60,000. If it would have cost you 50, and I'm giving you 10 on top, so that's the value proposition when we're approaching one of these deals. And that's the way we pitch it is there needs to be something in this for you. You don't just put your credit on the line expecting me to pay your mortgage unless you're getting paid for some reason or you're escaping some major pain.
So then I'll play devil's advocate as a seller, because the people who are doing these creative deals, are they typically buying them to rent them out, to flip? What is the general?
Not flips. Usually flips are rare unless there's a huge value add and I treat your loan as a bridge loan. But if you've got a 2 or 3 or 4% rate, I'm trying to hold on to that thing. I'm not trying to flip it and let that loan go. Your low interest loan, this is what I tell people. Your low interest loan is an asset that I want to buy. So typically it's buy and hold. It could be to resell it on a wraparound mortgage to a different homeowner. If I were to, that's more complex, but I can take your 4% rate. If I get ownership of the house, then I can sell the house to somebody else at 7% interest and I keep the difference.
Oh yeah, kind of like you're servicing the loan, and that's how much it costs to service the loan. And
sure, yep.
Okay.
They know they've got a 7% rate, and I've got a 4% on the back end. I still have to pay this one behind me. You pay the one to me, and I use what you pay me to pay that one. But I still have an agreement to pay that one, an illegal obligation to pay that one, even if you don't pay me. So there's a lot of complications in creative finance. So I would say before you play devil's advocate, I'm just going to go ahead and cut it off some of it off at the knees and say, don't go for creative finance out the gate. It's not your first angle. It should be
Right.
the last. Creative finance should be used as a solution, either to a problem. It's usually to a problem.
Mm-hmm.
And so if there's a cash deal, do it. It's clean and you're done. If the realtor works and somebody can bring new financing in, it's clean. There's complete separation. You're done. If you can keep it and rent it out for yourself or have a different property manager come in and do it, it's clean because you don't have this entanglement of two different parties who can make mistakes or betray one another.
Yeah. Yeah, because my concern's always been, okay, if let's say I have a house with low interest rate, we do the subject to, and then that new buyer defaults. So then you have the due on sale clause. I get the property back. Great. But now not necessarily. So what happens if
We'll get to that.
Okay, so what happens if the person buys? So let's say the buyer defaults.
Yeah, so we'll take the two issues separately. One is if the buyer defaults, doesn't make payments. The second one is due on sale clause. That's a separate issue.
Okay.
If I bought your house and didn't make payments, that looks bad on your credit because the bank's not getting paid. They still have your credit attached to it. It starts counting against your credit report. You can make those payments to keep your loan in good status. Now, if you sold it to me on a wraparound mortgage or deed of trust, then I'm in default with you, but you can preserve yourself from being in default with them. Most sellers don't have the cash to keep making these payments to the bank while they're in a default with their buyer. So it looks pretty bad, and you would have to pursue a foreclosure. And what state are we mostly talking here?
Probably California. Yeah, probably California.
Long foreclosure timelines.
Yeah.
So it's less viable in that state as opposed to Texas, where the foreclosure is, if the stars align, 21 days.
Okay.
So in Texas, you're looking at anywhere from 3 to 7 weeks to foreclose on somebody who's in default. That's a much more favorable place to be a lender. And if you're selling your house to somebody else with wraparound financing, like sub 2 like this, you are becoming a lender. And if you have to foreclose on somebody, that's expensive, takes a long time, and it doesn't stop you from having to pay this bill behind you.
Okay.
Certain states, it's tougher. And I would do something more along the lines of, so the structure of the deal can change. We can use a different legal instrument like a contract for deed, which is legal title stays with you, but I get the beneficial ownership. I get to use it, live in it, get all the benefits except legal title still lies with you until I finish paying it off. Very similar treatment.
Okay. And the advantage there is who gets the equity then? The buyer?
Mm-hmm.
Okay.
The buyer gets the equity, any equity gain. So we're in a contract for the deed, which means we have a fixed strike price. Any equity gain or something like that, if I refinish the floors, that's my benefit, not yours.
Sure.
Now, if I default, and not every state has this, but if I default early in the relationship in particular, if you have it in the contract, sometimes you can cause a forfeiture. If you give me back my down payment, you can treat me like a tenant and say, evicted, get out. You've defaulted too bad. I'm exercising the forfeiture provision in here.
But if you went through this agreement with the intention of renting it out, now the previous owner now is maybe inheriting a tenant.
Yeah. Yep. Yes. So we're getting into the messy parts of what can go wrong. And that's important because if the heat's too hot, stay out of the kitchen. And not to mention, we're going through all these technicalities and problems that can happen. And on top of that, we haven't even hit the due on sale clause, which is why I say creative is not your first option.
Fair enough. So it's one of those situations where like it could make a ton of sense for the right people, but there's risk, and arguably there's risk on both sides. Because I remember I was talking to a developer where someone was trying to do something similar with the developer, and so the developer started doing digging into it and saw that person actually has a history of defaulting.
Yes.
Right. So you have to do your due diligence ahead of time.
You should be background checking buyers, credit checking buyers. That said, credit checking buyers, if their credit's never on the line, isn't going to pull anything up, is it?
So there's some level of risk, but the VA angle is actually interesting because it's true. It's like I'm talking to people who are like, what if I want to sell in 2-3 years? I'm like, then you shouldn't buy because there's just not a ton of appreciation that's going to happen over the next 3 to 5 years. At least that's what I'm seeing.
And you're mostly paying interest.
That too. So your loan buy down isn't going to be massive.
So unless it's cheaper than renting for some reason and the cost to sell your house isn't going to be prohibitive, I think that the break even for one of those people, given various scenarios, is between 3 and 7 years, depending upon the market.
I tend to agree. Yeah.
Yeah. So if you're using a VA loan to buy a property and you don't intend to keep the property for at least 3 to 7 years, probably closer on the high end, then you're break even somewhere in that period after all costs. What's the difference between that and renting?
Right.
Figure
No.
it out.
Yeah, I agree. So then in your case, 3 to 5 years go by, let's say they don't have enough equity, but someone said, look, I'll assume your loan and I'll pay you a little bit. Then there's, okay, it's not ideal, but it gets me out of the property. I get some cash. And I would imagine the buyer is going to have some level of commitment to refinance at some given point.
You can.
You can.
It's a big fat whiteboard. Do what it's, yeah, that's the problem with whiteboards and the beauty. It's open negotiation. Put whatever terms you want in there. But I question the need. I understand the intuition, the desire for, okay, but I want you to refinance it in 3 years. All right, from the buyer side, why would I want to do that? If I'm buying the rate, I want 30 years. I want the remaining 27 years of this rate. The reason I'm buying this is it's an interest rate I don't think I will see for the next 10 to 15 years. I don't want to have to get rid of that, or the value proposition goes way down for me. If I have performed, additionally, if I've been performing for 3 years without default, why do I need to refinance? Right? We've already gone through a seasoning period. The likelihood of me defaulting is way lower after the first 6 to 12 months of seasoning. The relationship's more mature and more stable. Yeah. And equity is building gradually. So I always challenge the balloon or the payoff or the refi or something like that. It has to make sense for both sides. And I think a lot of buyers negotiating their first sub 2 deals are like, that's a reasonable request. I'll just say yes to it. But in the underwriting on the backside, you've got usually like a break-even deal that will be profitable in 5 years as equity builds, as rent rates go up relative to the mortgage payment. But you just set yourself to refi or sell, and you're not going to make money at that point.
Yeah. A great example is the multifamily market, the commercial market, right? They have these balloon payments every 5, 7, 10 years. And so a lot of them are actually selling pennies on the dollar because rates have gone up, but the rents didn't catch up. And now they're like, I got to trade, or I got to call my investors to pour more money into it, which is never a great call.
Yeah. And the lenders really have everybody by the short hairs on that because they're just restarting the interest period every 5 to 10 years. If you get a 30-10, then you're paying mostly interest for the first 7 years. You really start paying principal 7 years in, and then they're like, oh, let's start that over.
Yeah. I know that's been all my rentals are 2 to 4 units, and I really want to get into the bigger world. And that's always been my biggest fear. I'm like, I don't want to be stuck with this.
Starting with more equity, using more cash to do that, or taking somebody else's loan over and understanding that sort of thing. In the commercial world, sub 2 is more dangerous because of the due on sale clause. So let's get into the due on sale clause.
Let's do it.
What do you know about it so far? Have you heard of it?
Yeah. So my basic understanding is if the buyer defaults, let's say, or stops making the payments to the seller, right? So the payments are not being made, then the due on sale clause is basically, okay, instead of going through the full foreclosure process, the deed just goes back to the seller. And you're, based on your look, I'm like, probably what, 30% there?
You're mixing terms up. Yeah, you're close.
Oh, okay.
You're thinking of a deed in lieu of foreclosure.
Damn it, you're right. Okay, sorry, it's a long day. Go for it.
You were 30% there with the, if the borrower defaults, then,
okay, great.
So the due on sale clause is if you transfer the property, if I'm your lender and you're signing a contract, the mortgage that says if I default, you can foreclose on me. That's what a mortgage is. Okay. So one of the clauses that I as a lender put in there is a due on sale clause. If you transfer the title to somebody else without my consent, I didn't get into a relationship with Jim Bob. I got into a relationship with you. So if you transfer it without my consent, then I can accelerate the loan. I can call the whole loan due. The full balance is due in 30 days. That's your next monthly payment, and it's a fat one. And if you miss that payment, I can foreclose because of your non-payment issue. Now it's a non-payment default, and I can push. So when you transfer the property in a sub 2 transaction to somebody else, you are committing a default on your mortgage. Not a criminal act, it's a civil act. In fact, it's all contained. Think of the mortgage as a container. It's a contract that contains all the things. It says, if you transfer without our consent, we can accelerate. If we accelerate and you don't pay, That's a monetary default. If you commit a monetary default, we can foreclose. It's like it's all contained.
Mm-hmm.
So it's not a what if scenario in anybody's world. If you do it, they can. So if they notice that you've transferred, number one, if they notice, because we ask forgiveness, not permission.
Right.
And if they care, sometimes they notice and don't care. Actually, plenty of times they notice and don't care. If they're getting paid, what incentive do they have to upset that relationship? Especially if it's a relationship where the borrower was in default for a long time, and I, as the buyer, came in, caught up $25,000 worth of payments, put the loan back into good standing, and I have been making payments for the last 6, 12, 15 months. If you notice that, why would you upset that?
To be fair, I think a lot of people don't realize is banks don't want to sell these properties. They don't want properties
want
to be in foreclosures. Yeah, they don't want to.
And foreclosure is expensive. Now let's look at it from this side. If you're a lender in California, it's going to take a stinking while to finish that process. So don't upset the apple cart. From the lender's perspective, let's not mess with this. If we're getting paid, shut up.
Yeah.
You know, we can always accelerate later if we don't like something that goes on. If they stop paying, then we've got them dead to rights. It's in the contract. If they transfer without our consent, then we can accelerate the loan and foreclose. So we're in pretty good shape. You're well protected as a lender. That said, sometimes they do accelerate. With or without logic, sometimes they do it. And you can't get rid of the due on sale clause. It exists in there. So hence company number 2, due on sale, DOS guard.
Yes.
We can't prevent it from happening, but we have fixed it going on 30. We're coming up on 36 times now. I lost count. We haven't failed yet. But we can't guarantee success either.
Right.
So DOS guard is not insurance, because people kept asking, can you give me sub 2 insurance basically? No, I can't insure it, but I have fixed it enough times where I'll let you pay this much for remediation ahead of time instead of this much for remediation if you call me after it happens.
Okay. Got it. Because it's going to happen. So it's just about if it does happen. So it's just about
it happens less than under 1% of the time is it happening.
I mean, I believe it. It's in no one's best interest.
I don't think we established the level of my depth of expertise, not as a bragging point, but Creative TC has existed for 3.5 years. Going on 4 years next month. And we've done 30 to 50 deals a month for most of that time, only sub 2. I have seen, touched deals in every state, with every lender, with every type of loan, with every type of deal structure. I've seen it and touched it all. I'm a deal architect. So when I talk about this stuff, it is not only research-based. Much of it is very direct, firsthand experience-based.
What have you noticed any similarities between a lot of these transactions? Are they mostly sellers that are behind on their payments?
Yes.
That's the majority of it?
That's the majority. Yeah, it's usually pain motivation, avoidance of pain or consequences more than it is acquisition of additional funds.
Which is interesting because it's changing. It used to be the majority of Americans had equity, but now with more and more transactions happening, that's slowly shifting. It's still probably majority, but there's going to be a percentage out there of anyone who bought within the last 2 to 3 years that may just not have enough equity, or the condo market hasn't done well, multifamily market in some markets haven't done well.
Yeah, the low interest rate loans have a lot of equity.
Right.
What I call low interest, and I'm 38. So when I was a house buyer, people who are 50 and 68 are like, you don't know what you're blessed and you don't know what the normal interest rates are. And I'm like, 12% is high. They're like, that was normal. Oh, I'm sorry, sir. I grew up in this environment. So if I'm talking sub 5, anything under 5% interest rate,
that's fair,
has a good chunk of equity because it's a few years old by now, which complicates the offer mechanism too, because if you're my seller, what value proposition do I have when you've got a ton of equity? You could take a haircut on the cash portion or the price and have a clean exit. So this looks pretty convoluted because I'm not going to give you more than it would cost me to go get my own loan.
Right.
My goal is to pay less in cash. So then we have to finance some of your equity, and we've got the sub 2 payment and the seller finance on top as a hybrid. It's just more complex. They're less likely to go through what I call mid-equity deals, and they're very difficult to get through because they typically don't cash flow, because you're not going to accept $40 a month from me on $65,000 worth of equity that you finance to me.
Yeah, it's just not really worth
So
it.
the monthly payment ends up being too high for me.
Yeah. No, that's fair. So then let's talk a little bit about how like the seller might become the lender. So if we have some of these deals where there is no loan, it's free and clear,
Yeah.
but then there's seller financing, which similar, what it sounds like, similar risk in terms of if the person defaults, you could be inheriting their tenants, or if it's a mid-project, now you've inherited a mid-construction project, whatever it is, risk with any business, to be fair, right? There's risk everywhere. Why would someone take that deal versus just a straight sale if they wanted to do seller financing?
Somebody's going to make money on interest. Why not you?
Why not me? Let's see. Depends on how long the loan would be for, right? Because if you can cash out, it would take years to make that same amount of cash. Now, the question really is, what do you do with that cash that might be taxed? That was always my thought, was do a 1031 exchange, but what if you don't want to do a 1031 exchange? Seller financing might be the
let's look at you as okay, so from an investor standpoint, the 1031 makes sense as an investor seller, but what about a homeowner, like a traditional mom and pop individual?
Yeah. It could be a retirement deal. I actually know someone who's looking into doing seller financing for one of her properties, and it's a retirement pool. She's like, yeah, then my kid gets to inherit those payments and make some extra cash and all of that.
So as long as you collect enough down payment. So let's look at it from the perspective of, if I'm a seller, what do I care about? What do I want? If I own a property free and clear or almost free and clear, I want to collect enough down payment that it's worth the risk that I would have to foreclose on you.
Which would be typically how much that you've seen?
15% at a minimum. 10% very minimum, but not very likely. 15% to 30%.
Okay.
30% is not very likely, but I want to collect enough that it's painful for you to walk away from payments. So you've got skin in the game. You made it worth my while to finance you. I can set aside some cash to pursue foreclosure if I have to do that. I want to be able to do that. That said, one of the angles that I talk about is, let's turn this house into an annuity. An annuity is something that somebody who's working toward retirement is a term that a lot of them are more familiar with. And so if I use that terminology, it's a fixed asset with monthly payments to me. It's fixed monthly income to me. The annuity concept really lands pretty well as a conversation point with them as well.
Yeah. It's only you get to get monthly revenue, and you didn't actually have to give them anything like cash out of pocket, right? Oh, you want to lend money to a friend. It's here you didn't have to. You could have zero cash, and you've basically turned this property into an income producing asset with no headaches from tenants, no headaches for renovations, leaky roofs, anything like that. You just collect your payments.
Yep. Can I share a screen on this thing or no?
I have not done it yet. Let me see. Hang on. Share.
Pushing the limits. Always we're pushing the limits. We pushing the limits, man.
There you go. I can share.
Okay.
But it does not look like you can. Unless you see at the bottom, there could be a share screen. I see a share screen.
I do have a share. I didn't know.
So try that.
All right, let's try it. Let's see. Entire screen. I got to pick the right one. I'm going to show you a calculator that I wrote for seller finance stuff a long time back.
Okay. There you go.
Okay. We're going to zoom this in so that everybody can see clean. All right. So I'm just going to use an example. $650,000 sale price. Let's look at it from the seller's perspective. 15% down, basically, $100,000. So that leaves us with a loan. I'm going to give you a loan of $550,000. It's a 30-year loan, 5% interest. These are all basic, easy to use terms. The monthly payment, that's principal and interest, not taxes and insurance, $2,952. Okay. When I go to talk about a seller side, why would you do this? Because, Mr. Seller, you're selling for $650,000, but you're getting $855,000. I'm going to pay you $855,000 for this house. Wait, what? Oh, that's actually, hold on. Let's call it with a 10-year balloon. So with a 10-year balloon, if you're like, I want $650,000 for the house, and I'm like, I think that's a little overpriced, but what if I give you $900,000? What do you mean it's overpriced? You're going to give me $900,000. Here's how. Have I got you interested? Because here's how it works. I'll buy it at $650,000. I'll give you a down payment. I'll pay you 5% interest, and we do a 30-year loan. I'll refinance it in 10 years. The way that works is you collect $100,000 up front. I will pay you $250,000 worth of interest over the next 10 years. plus I'll pay off the principal at the end, whatever's
Mm-hmm.
left. And you will have received a little over $900,000 in the next 10 years. How's that sound to you, Mr. Seller?
Right.
Well, let's have a conversation. You get what I'm saying?
Mm-hmm.
So that's how I talk through that.
Fair enough. So as a seller, what kind of due diligence should they be doing on the new potential borrower?
Credit check. Yes, you're borrowing in an LLC, but I'm going to still put a due on sale clause, not because I intend to foreclose or accelerate the loan if you transfer to somebody without my permission, but I want the ability to. I'm going to make sure that the contract has a big enough down payment, right? Enough skin in the game. A personal guarantee maybe, because I don't know you, but I want to be able to pursue your other assets for any deficiencies. That's basically it. It's pretty standard stuff. You can pay a service like, I know the owner of a service called calltheunderwriter.com. His name's Dan, and his company will underwrite somebody for you just so that you can get a bank grade loan with somebody. They'll produce the loan documents and everything. Let me underwrite this company, see if they have collateral, check the credit scores of the principals, and then I'll give you a rating on whether or not they're a good borrower.
Yeah. Easy. I say easy enough, but like
it's simple enough.
Simple enough. Yeah. There you go. Simple enough.
So this is all very doable, but then again, like back to my church analogy.
Mm-hmm.
I'm the general contractor. You don't have to know all this stuff. You just have to know a guy.
Right.
That's me. I have all these connections. And are you an agent?
I am.
Yeah. So you have the same value proposition. Right. It's not that you just can sell a house. It's that, hey, I know a roofing guy. I know a foundation guy. I know a landscaper. I'm paying you. The totality of what I'm paying you for is who you know, as well as the fact that you can type stuff into the MLS. That's not all I'm paying you for. Right. Do you have a good photographer? Do you have all these value things? You can for sale by owner if you want, or you can use me and you get my network and you get my experience and you get all the O's and oopses. That's what that costs. Same thing with creative finance. I have a consulting firm specifically to handle this sort of stuff and help you restructure the transaction.
Yeah. Now, who normally would reach out to you? Is it normally the buy side that would be reaching out to you?
My favorite is working for buyers.
Yeah.
I like being an advocate, and the investor buyer typically has the impetus there, and the seller is unsophisticated. And so I created my first company to make creative finance real estate safe, legal, and ethical. Fair. I see myself as a lighthouse. We have free 15-minute consults. That costs me money and payroll and other things. Mm-hmm. I do that as a service to the industry. Obviously, it gets me it's a lead magnet as well. But we have plenty of people book 15-minute calls to say, is this even a deal? What about this and this? Nope, that's probably not a deal. Okay, thank you.
Yeah. But it's also good for you because then you can determine if it's a good fit for your company. It works both ways.
Yes, because I don't do refunds. We do hefty deposits and no refunds on a deposit at least. So if I take any cash from you toward a deal, I want you to be sure it's a deal too. So that free 15-minute consult works as hey, it's easy for us to part ways. Nobody's mad. But once we engage, there's money involved.
Yeah, fair enough. That's one of the downsides on the real estate agent side is you can put in all this work, but if it doesn't sell, you don't get paid.
Yeah.
And but I told you that this was the price. I told you this and this. It's the nature of the business.
Yeah.
Yeah.
So that's why I have three companies. Number one is the consulting firm. Mm-hmm. There's limitations on what we're allowed to do because we're just consultants, but we've got the experience. We've got the best practices. We've got a library of documents. We don't nickel and dime. If you're using us and we have it, it's your resource. Mm-hmm. Then people ask me to protect me from the due on sale clause. So we figured that out. We offer a service. We can just throw it in as a closing expense. And then I wanted to do more things that I can't do without a license. And so I started a title company, and that's in Colorado right now.
Okay. And then the title company is just your typical title company, but you specialized in the creative financing because there's always a little bit more nuances to it.
Which Batman was it where the dude's got the black mask and he's, you merely adopted the darkness. I was born in it. And I'm like, with creative finance, I'm looking at other title companies and I'm like, you just adopted it. I was born in it, homeboy. Yeah. I came up in creative finance. So what you do is easy to me.
And it could be very complicated. So you do need the right people in place.
Yeah.
That knows how to navigate this.
But we do all the normal transactions. But yes, we specialize in creative finance in the state of Colorado.
Nice. Okay.
We'll grow.
Okay. So then, because I know we're heading towards the end of this, for someone who, let's talk from the buyer side and seller side, you're saying that this is not a last resort, but it's a solution. When should they start thinking about doing these types of creative options?
You're probably going to be talking to sellers. So I would say agents need to be aware of the strategy.
Mm-hmm.
Again, you don't need to understand it in depth. You need to know a guy and come
Right.
get a free 15-minute consult and see, is this a good option? So be aware of what sub-2 and seller finance are and some of the risks, and be able to have that conversation. Are you willing to take this risk and this risk? For sellers and buyers, if you're looking to buy the rate, just go get on a wholesaler's list and ask for creative deals. You'll see them out the wazoo. People are finding them and putting them under contract all day. As a seller, can I not get the price that I want? Will the house not pass inspection so that I can get a traditional buyer? Do I need help getting it fixed up to a point where somebody else would be able to buy it? Usually that's, do I have no equity? Is it going to cost me money out of pocket? Now, if you haven't engaged an agent yet, once you engage with an agent, you owe them their commission if and when you sell your house.
Yeah.
So if you're pre-agent, you can save that fee and find somebody who's willing to take that over. Yeah. Call around to wholesalers. They'll collect a fee too, but they collect it from the buyer, not from the seller side. And for example, a low equity seller, FHA loan, VA loan, you can just wholesalers in zip code XYZ. You'll find one, I promise. And they will be anxious to put you under contract.
Oh yeah, for sure.
They're little sharks too. I get most of my business from wholesalers, but you guys are sharks and you're out for the money, and that's fine. I get it. But as an unprotected, unrepresented seller, that's dangerous waters to swim in to go direct.
It's interesting because wholesalers have no fiduciary responsibility to anyone.
Yeah.
So versus as a realtor, yeah, we sign a contract. We have fiduciary responsibility to somebody. And so what I always thought would have been interesting is if the Department of Real Estate, whatever, they came down and said, look, because we have the clear cooperation policy, we're not allowed to have pocket listings anymore. Which really gave way for wholesalers. Like, hey, look, you want to advertise your property off market? You can't go with the realtor, but you can go with us. So it's like if we got rid of that, saying, no, you can have pocket listings again, but we're banning wholesalers. Wholesalers can still charge a fee. It's a misconception. They think realtors only charge percentage, but they don't have to. They can charge a flat fee. So wholesalers can still operate the same way they always have been, but now they actually have a license and they have a fiduciary responsibility. It would be interesting if that's how it would play out. I don't think it'll ever happen, but it was an interesting route.
I see a lot of, remember, I see a lot of deals all around the country.
Sure.
The more mature wholesale operations I see have at least one agent. The national wholesale teams that I see are making all their people become agents to do the wholesale stuff. But the individual operations, the more mature they are, the more likely they are to have at least one agent on the team who can be the agent of record for buying or selling or both or whatever.
Oh, interesting. Yeah, I mean, it's in theory. So I guess a workaround is you can always do a single party agreement. So it's not really a listing agreement, but somebody gets paid. That's really the workaround. It's just for a lot of agents, if they don't have that signed up front, then they're taking the risk of it selling and them not getting paid.
Yeah.
Yeah.
The thing with wholesalers is they can negotiate their own assignment fee, right? So it's variable, and they can negotiate with buyers to find out who's going to buy at the highest price, and they're the ones keeping the difference. With a realtor, it's not like you get to keep the difference.
You can. I just never seen it done.
Yeah.
But you can actually structure it that way. But most people do percentage, and the argument is then we're both incentivized for you to get the best price or whatever the case may be. You know, so that's a whole nother conversation. I'm not a big fan of most realtors, but there are some very good ones out there. I know.
Same. I'm not a fan of most wholesalers either. And I've done wholesaling. I'm not actively a wholesaler. I own some rental properties. I'm a real estate service business guy. I'm here to make real estate safe, legal, and ethical. And that's pretty much all I'm about. Which means when I engage with somebody, I actually need to warn a couple of people away, because if they bring me a deal and I'm supposed to advocate for you, I'm also advocating for safety, legality, and ethics. And that means if you're getting into a sub-2 deal as the buyer and your seller doesn't understand with relative completeness and the ability to explain it in their own terms what's actually happening, I'm shutting it down, dude. I'm out of here. I'll say, this is what needs to happen for me to continue. I'll happily refund your money, but I'm going to tell them to make sure that they understand.
It's interesting. What people don't realize is every industry is like this. It's huge, but it's small. Right? I remember I saw a property once that was a flip, and it was just the quality sucked. And so it's like that always stuck with me. And then I see another one of their flips, And I told my buyer, I said, look, I've seen their work before. It wasn't great. I'm just giving you a heads up. They didn't buy it. A few years later, went back on the market. Somebody did buy it, and they had to drop like 80 grand to fix everything. It's like, now people know. Your reputation is so important in this line of work, especially because there's such a low barrier to entry on the service side.
Speaking of which, we fight hard. I'm big on giving a ton of value. I'm really proud of my team. They've done a great job. I had my receptionist tasked with chasing down calls after a deal is done, a week or two after, just to say, hey, do you have any follow-up questions for us? Because we're still here. A title company is usually closing day, done, don't call me again. We're like, listen, we care that this deal is set up correctly for the long term. This is a springboard for you to be in a relationship, buyer and seller in a relationship for the next 5, 10, 25 years, maybe. You need to understand what you're doing. You need to be okay with one another. You need to have each other's contact info. Stuff will happen and you have to work together in the future. So if you have questions, we're still here. So they're calling it and offering that. And I was like, oh, we should be asking for 5-star reviews. I said, just record our side of the call and make a transcript and say, hey, thanks for that. Can I send you what you just told me and ask you for a 5-star review?
And just copy and paste.
We just did all the work. We sent it to them. It was your own words. We've captured it. We've edited it for grammar and stuff and quality and send it to you. You copy paste it if you want, or you can edit it, whatever you want to do. Dude, I got testimonial reviews out the wazoo. We've got 250 5-star reviews. Nobody else has it.
Yeah. No, very cool. All right, Caleb, thank you so much for this. I learned a lot because we always hear about it, but we don't talk in depth. How can people get a hold of you if they have more questions or want to go down this path?
Ooh, I'm not going to list a bunch. There's just the one, and you can find the branching paths from there. CalebChristopher.io. I've got a newsletter there where I share my actual financials from rental and business. I've got the links to Creative TC, DOS Garden, Creative Title. They're all right there. That's CalebChristopher.io.
Perfect. All right. Thank you so much again for being on the show. It was great. Thank you for everyone for watching and listening, and I'll talk to you guys next week. Want to keep unlocking the secrets to building real wealth in Los Angeles? Stick around for the next episode. Tap the video on screen to keep watching.